Good morning, everybody. Thanks for taking time out of your morning to kind of stop in with us and go over this great seminar. Noelle is presenting for us today, and I'm sure she's going to have a lot of great information for us. As Matt said, we're doing a webinar now, and so only the panelists will be seen, and it'll allow you guys to just kind of like take in the information, relax a little bit, and we're going to have some interactive polls as well. So we're going to keep it to an hour. And we're also, if you have a question, just drop it in the chat for us and we'll address it. And we're going to go over financial statements and ratios today and kind of get into the basic framework of it. And I think also some essential categories. So I'm really excited. It should be a good one. And I'm going to let Noelle take it from here.
Okay, so let's get my screen shared. And very good. All right, as Anna had mentioned, my name is Noelle Taucher. I am a controller within our external accounting group here at Donnelly-Boland. And I'm very excited to be presenting to you today some information about financial statements and financial ratios. So in today's society, in a current business environment, everyone, whether you're a financial professional or a non-financial professional, you're definitely challenged to manage and ensure full and efficient utilization of limited resources to improve your profits and productivity and achieve your company's overall business success. This is going to require you to have a thorough understanding of your financial statements and your ratios and trend analysis. And hopefully we can help you on that path here today with giving you some helpful hints and tips and tricks. So our agenda today, we're going to cover cash versus accrual basis of accounting. We're then going to dive right into the financial statements, the basic framework of these statements, how to prepare and use and review these statements, and how these statements are going to help you with your ultimate business decisions for your company. Moving on, we'll go into financial ratios, covering what I think are the 5 key categories of financial ratios, how to prepare and calculate these ratios and use them and interpret them, as well as using these ratios to help with those business decisions. In my mind, you have to use your financial statements and your financial ratios to give you that complete analysis of your financial picture. Then we'll wrap up with some high-level key point takeaways from today's seminar. And I hope to leave some time for Q&A at the end. As Anna had mentioned, she'll be monitoring the chat pod. So if you have a question, just go ahead and pop it right in there. If it's something we can address while we're talking about a particular topic, we'll certainly answer it then. Otherwise, we'll make sure to address it at the end of the seminar. Just as an overall picture, as I mentioned, using this financial statement analysis and ratios, you're going to be able to make more informed decisions on your business. You're going to know where you need to look in your purchasing, selling, inventory, receivables, payables, all of those interworking pieces of your company. And these overall analyses are going to help you deploy your business's resources in a more effective manner, which is going to help you on all fronts. Revenue growth, cash flow management, debt management, all those big pieces to help your business have ongoing success. So let's talk a little bit about cash versus accrual accounting. Cash accounting is the basis that many small businesses are going to opt for because it's quicker and simpler. You can essentially use your bank statements to get a picture of your overall financial performance at that point in time. You recognize revenue when you get cash. You recognize expenses when you pay cash. That timing really revolves around when cash changes hands. However, this is really going to limit you when you're looking at your financials of your business. The preferred method, and preferred and encouraged and needed by GAAP, which is generally accepted accounting principles, is the accrual basis of accounting. So the accrual accounting method is going to provide a long-term picture of your business that cash accounting just cannot provide. The downside is if you don't monitor your cash flow, there can be terrible consequences. Because in accrual accounting, you're recognizing revenue when you've earned it, when a performance obligation has been met, when you have shipped those goods to that customer and they have taken ownership of those goods, when you have performed a certain service for a customer. That's when you would recognize your revenue. It doesn't really matter if that customer has paid you in cash yet for that work you have performed. You also recognize your expenses when you incur them, when you have consumed that good or service that you have purchased from an outside vendor. It allows you to match your revenue and expenses in the time period in which they occur, which is great. And it's going to give you a more realistic picture of your company's income and expenses. But as I mentioned before, you still need to look at your cash flow, because highly profitable companies can have really poor cash flow, and the opposite is true. So you definitely need to monitor your cash flow, and there happens to be a fabulous cash flow statement to help you with that when you're preparing your financials on the accrual basis of accounting. And our discussion today is going to be focused on that accrual accounting method and the financial statements, ratios, and analysis that are all tied within that. So what are financial statements? Financial statements are those formal records of the financial activities and position of the business. You're going to get your financial information presented in a structured format in a way that's easy to understand and comprehend, and it gives you comparability, whether it's to your own other historical financial statements in your business or across your business industry, looking at competitors and seeing how you rank with them. Correctly prepared financial statements are going to alert you to red flags or those potential problem areas, as well as show you your high performing parts of your business, where you maybe want to focus some of your growth plans. Financial statements are important because they represent the overall performance of the business. They're going to help you make those key important decisions to keep your business thriving and moving forward. They represent that output of your business's financial performance. So your company, your business, it can't talk to you. It's not an animated being. It just kind of exists there. But financial statements and analyzing those financial statements gives your company that language, that voice to tell you, hey, I'm performing fantastically, or there's some weak spots here and you might want to address those before they get to be a big problem zone for you. There are four main financial statements: the income statement, the balance sheet, the cash flow statement, and the statement of changes in equity. They all work together and are interrelated as an overall financial statement package. I love the financial statement package, and I think my favorite part is the fact that they all work together. What your balance sheet shows as the ending cash balance needs to tie out exactly to your cash flow statement as your ending cash balance. When something isn't working, there's an issue or something needs corrected. There's a discrepancy somewhere. So this overall financial package is going to give you that overall picture of your company and going to tell you the complete story of how your business performed during the time period that you are reviewing, whether that's a monthly, quarterly, or annual look, or even a multi-year comparison. So let's talk about the overview of financial statements before we really dig in. The first one is going to be the income statement, and this is going to be the financial performance of your company. It's going to represent the earnings through a specific period of time. You're taking your sales revenues minus your expenses, and you come up with your net income or net loss, that bottom line that you hear, other people talk about. Keep in mind that since we are in the accrual basis of accounting, your income statement is a measurement of your profitability, not your cash flow. There's a whole separate statement to monitor your cash flow that we'll be talking about. Your balance sheet is going to be a picture of the financial health of your organization. It's going to show you what your company owns versus what your company owes. Your assets have to equal your liabilities and your equity. Both pieces on either side of that equal sign need to be the same. As I mentioned before, that whole separate statement to monitor your cash flow, the cash flow statement, it is going to illustrate the cash management of your organization. It's going to represent your cash inflows and cash outflows over a specific period of time. It's going to show you your sources of cash. How is that money coming into your business? Your uses of cash. Where is that money going out of your organization, as well as the overall change in your cash balance from beginning to end. And the fourth main statement in your financial statement package is your statement of changes in equity. This is representing your overall company ownership position. It's illustrating if your business has accumulated positive or negative equity. And it's going to show those changes in equity over a specific period of time. So the statement of changes in equity essentially acts like a roll forward of equity balances from the beginning of a period to the end. It's going to illustrate transactions, excuse me, like net income, dividends, and stock issuances or repurchases. Because of the limited time we have in this seminar, we don't have enough time to cover this particular statement in detail today. Our focus is going to be on the other three. However, as you're reviewing and analyzing your income statement, balance sheet, and cash flow statement, you're already taking a deep dive look at the other transactions that impact the equity statement. So it's not as important to analyze your equity statement, but you do need to ensure that your statement of changes in equity does tie out and rolls appropriately for the period under review. And now we have to do the poll question. And I apologize, this is the first time doing the polls, so we're going to do two in a row because I actually forgot to do the first one. So here's our first polling question. And it is, which basis of accounting are you most familiar with or use currently? Is it cash, accrual, creative, meaning you kind of do what you want, or don't know, undecided? And I'll leave that poll open for a few minutes, or not a few minutes, we'll leave it open for about 20 or 30 seconds to give you a chance to answer, and then we'll show our results. Okay, we're going to end the poll and share results. And it looks like most of our audience is most familiar with accrual accounting, and I am very pleased to report that no one selected creative accounting. That one makes me nervous. So we're going to stop that one, and we are going to move into our polling question 2, and I do apologize that I didn't do these in the right order. But which financial statement do you feel provides the most insight for your business? The income statement, the balance sheet, the statement of cash flows, the statement of changes in equity, I love them all, or not sure, don't know, or undecided? Same thing, we'll leave it open for about 20 or 30 seconds to give everyone a chance to record their answer. All right, and we'll share those results. It looks like most people love them all. I am in full agreement with you. I think the entire financial statement package is just a beautiful sight to behold. I love reviewing all of them. And coming in second was balance sheet and the income statement. No one picked my absolute favorite statement of cash flows. That's okay. All right. So let's get back into the overall presentation here. Let's take a look at the income statement. So I have a very, very basic income statement up on the screen. We're going to go line by line and talk about the positive signs you should be looking out for when you are analyzing this statement, as well as some red flags or potential trouble areas. So first line is your sales revenue. These are the sales to your end customers, the goods or services you have provided as your company. The next line is your cost of goods sold. If you don't have inventory, this could be just your cost of sales, but this line item is going to represent the costs incurred to produce the sales or revenues. When you take your sales revenue minus your cost of sales, you end up with your gross profit. Now, your GP is what is going to provide the resources to cover the company's other expenses, those other expenses that don't really drive your actual revenue streams. The more stable your GP line is, the more opportunities there are going to be for your business to grow. You want this to be positive and see growth when you're reviewing trends and comparatives to prior periods. The next line represents your selling, general, and administrative expenses. And in the accounting world, we love our acronyms. We call this SG&A because then we can talk faster when we're talking about things. So our SG&A line, that's going to be your area where management can usually exercise the greatest control over this section. These are things, again, that don't drive your revenues, your utilities, your rent, your sales staff, salaries, and benefits, things like that. You definitely need to watch this line and watch this trend, especially as it relates to a percentage of sales, because that's going to alert you to any problems with managerial inefficiency. If this stays steady as a percent of revenue or decreases, you're being pretty efficient at using your non-cost of sales expenses. Subtracting your SG&A from gross profit is going to give you your operating income or loss. Obviously, you want operating income here because this is a measure of the operating profitability. It's going to show you your company's earnings before non-operating costs are considered. Excuse me. The next line is interest expense. This is going to represent the costs of your company's borrowings. If this gets to be too high as a percentage of revenue, that means you're relying too much on debt and borrowings to run your business. You really want your interest expense line to be in alignment with your overall strategic initiatives and goals for your company so that you're not incurring too much debt and therefore too much interest expense, dragging down your overall income statement. Subtracting your interest expense from your operating income gives you your earnings before income tax. Obviously, your income tax expense is anything that you would have from a corporate tax perspective. And there's going to be several ways you can impact your income tax expense year after year. There's charitable contributions, there's bonus depreciation, there's extraordinary write-offs. The tax code and laws change so drastically every year, pretty much, I feel like, that this could be skewing your overall annual results. But you do still need to take them into consideration. Subtracting your income tax expense is going to bring you down to that bottom line, that net income, net loss of your company. This truly represents the bottom line of a company's performance. And this is what ultimately is going to become part of your company's equity position as retained earnings when you roll it forward at the end of your annual period. So your bottom line is typically the one that gets the most attention. Even, all non-financial people talk about bottom line, how important the bottom line is. However, sales revenue is really important to focus on. You can really only grow profits if sales grow, because your margins that you earn on your sales revenue dollars tend to flatten or diminish over time. And that's because maybe the goods you're selling become commoditized. Maybe the services you're offering, you're getting squeezed by your customers to, bring those prices down. But maybe your vendors, your costs are going up. So you need to take that into account. Where can you have organic growth? That's your internal growth of revenue. Maybe can you expand into new markets? Can you add new product lines or services to already what's in your wheelhouse? Maybe you need to look at external growth, merging or acquiring a company that is synergistic to you. These are all things that you'd be wanting to look at as you're monitoring your sales revenue and tracking the trends from year to year. So reviewing and analyzing the income statement is going to help you see those trends in revenues and GP, which is going to help you make decisions on which revenue streams to stay in or abandon. Maybe you have a revenue stream that you're noticing that GP is really dragging you down. Maybe it's something that you started with your company, but it's not really providing that same bang for your buck. Maybe it's time to have that tough conversation and either move out of that space or find a way to improve it. Do you have any cost-cutting measures you need to address? Maybe you need to have some more income tax planning, making sure that the way the tax code reads today, you're taking the most advantages that you can. And it also helps you determine how to maximize your debt to keep aligned with your overall company's goals. So what are some overall good signs that you want to look for on your income statement? Obviously, positive numbers across the board. You want to see positive GP, positive operating income, and positive net income. Your comparatives should show revenue growth and profit growth with expenses staying flat. You want to see that SG&A line as a percentage of sales staying constant or decreasing. What are some red flags and bad signs, some warnings that you should be aware of? The opposite, negatives at any line, negative profit, operating loss, or a net loss, not good. Declining sales or profitability as you review trends, don't want that. And if you see that SG&A line increasing as a percentage of sales, you definitely want to attune to that as quickly as possible and start discussing some cost-cutting measures or cost containment. Balance sheet. So we have very, very basic example of a balance sheet here on the screen. And as you can see, our assets make up the left-hand side and our liabilities and shareholders' equity make up our right-hand side. And just like a balanced seesaw, you'll see that total assets of $3,875,000 agrees to our total liabilities and shareholders' equity of $3,875,000. What's on one side has to equal to what's on the other side. I've spent a lot of time in algebra over the last year with my kids in virtual school, and it's the same thing. This is a perfect use of algebra in the real world. What's on one side of the equal sign, you have to do to the other side of the equal sign. You cannot let them be out of balance. Within your assets and liabilities section, you're going to want to break out your current and long-term assets and liabilities. So what do I mean by that? Well, current assets are those assets that are liquid in nature. They are things like cash or items that you expect to turn into cash within 12 months. They have a life of 12 months or less. Long-term or short-term liabilities are the same thing. They're your current obligations that you expect to have to pay out within the next 12 months. Long-term assets are going to be things like your property, plants, and equipment, or your intangibles, assets that have a life longer than a year. Your long-term liabilities are going to be your outstanding obligations that aren't due until more than a year, more than 12 months from the date of your balance sheet. By reviewing and analyzing your balance sheet and comparing it to prior periods, it's going to help you determine your company's ability to collect and pay debts over time. A strong balance sheet is based on the effective management of the main or core assets of the business, which those are typically going to be your cash, accounts receivable, inventory, and property, plant, and equipment. As we're going to discuss once we get into the specific ratios and analysis section later on, your assets need to generate sales dollars in some way. Having too many assets could be just as bad as not having enough. You're bloating your balance sheet and they're not working for you. They're not helping you turn those assets into sales dollars. Other things to look out for on your balance sheet, your current assets should be in excess of your current liabilities whenever possible. This is going to indicate that you have enough liquid assets to pay your short-term obligations. In our example here on the screen, you'll note that we have total current assets of nearly $2 million and total current liabilities of a little bit over $500,000. This is an extremely strong balance sheet. This shows that we have nearly 4 times the amount of current assets as current liabilities. So if all of our creditors that we owed money to in the next 12 months came knocking on our door and said, hey, you need to pay up, we would be able to do so and still be a strong company. You want to make sure you're looking at your long-term and short-term debt and borrowings. Those can really drag down a balance sheet and make it weaker, as well as the interest expense on those debt borrowings can make for a weaker income statement. So you need to make sure you're keeping your debt and loan obligations in line with your current business performance, as well as your future growth expectations. Another thing to do while you're reviewing and analyzing your balance sheet, you need to take a look at your capital improvements. When you're considering how improvements or additions to your current property, plant, and equipment fixed assets, or as you're considering making those, you need to think about, if I make an improvement here, is that going to generate additional sales? Ultimately, when you add new assets, you want them to help your bottom line on your income statement. You don't just want to invest cash or take on additional debt to make a capital improvement if it's not ultimately going to help you generate additional sales dollars. Looking at the equity section, you're going to be able to determine right away, do you have positive or negative retained earnings? Positive retained earnings is going to show that your company has enjoyed past and current success. Negative retained earnings might be okay if your company is in its infancy stages, but if you had positive retained earnings before and you're starting to see that balance drop down and go towards the negative side, it's trending negative, those are warning signs. Something's occurring in your income statement to start chipping away at the positive equity you had built up. Warning signs to definitely be on the lookout for in the balance sheet are mountains of debt, little to no cash, or excessive growth of assets with no comparable sales growth noted. So in addition to everything else we talked about, those are the kind of the red flags and trouble zones you definitely want to be aware of. My favorite, the statement of cash flows. So again, very basic example up on your screen. The cash flow statement breaks out your cash into three categories of that cash flow: the operating, investing, and financing. So your operating section represents your current business operations. In this section, you're going to take your net income, add back any non-cash expenses like depreciation and amortization, plus the balance sheet impact of your asset and liability increases and decreases. So why do we do that? Well, non-cash expenses, you had to subtract them to arrive at your net income number that is shown on your income statement, but there really wasn't a cash impact for those expenses. So you need to add those back to make sure that you are correctly illustrating cash flow related to that. What about those balance sheet impacts? Well, when assets increase, you decrease your cash flow. When liabilities increase, you increase your cash flow, and vice versa. Let's talk about a couple examples. Accounts receivable. Let's say at the beginning of January 1, you had outstanding AR of $250,000. Transact throughout the year, doing great sales, and you're turning those sales into cash. But at the end of the year at 12/31, you have an outstanding AR balance of $500,000, indicating an increase of $250,000 in your accounts receivable. That should show as a decrease in the operating cash flow section. And that's because you've already recognized that revenue related to those AR balances. So it's already in your net income number above. But again, you haven't actually received that cash from your customer yet. So you need to back it off your net income. The same is true, but opposite on the liability side. As an example, you start out January 1 with $100,000 in accounts payable. Again, you transact throughout the year, recording your expenses and liabilities. And at the end of the year at 12/31, you have an AP balance of $200,000. That indicates that your AP has increased $100,000 during that time period. But you've already recognized the expenses in your net income, which has brought it down by that overall impact. But again, that cash has not left your company yet. So that $100,000 increase to AP is also an increase to your cash flow and should be reflected as such in the operating section of your cash flow. This net cash provided by operating activities should always be positive. If not, it could indicate some issues here. Some issues that you would want to maybe dig into are evaluate your inventory policies and purchase strategies. Are you carrying too much inventory? Maybe not enough. You want to look at your AR collections and your terms with your customers, as well as your AP payment timeframe and your terms with your vendors. Can you add further value to your customers and maybe curb some expenses to increase your ultimate bottom line, that net income, the item that you're starting with in the cash flow statement? Positive cash flow here indicates that your company is providing cash flow from its operations, and that is a positive. So when this shows negative, you definitely want to dig in and figure out how can you correct that trend. The second section of the cash flow statement is your investing section. And this is going to represent the income you have from buying and selling long-term assets. So just keep in mind that if your business is experiencing growth, it's okay for this area to be negative. The key is to keep this area consistent. So let's look at our example. We purchased some new property, plant, and equipment for $250,000 on this cash flow. And we sold some of our old equipment and received cash proceeds of $57,000 during this period, giving us a net cash used in investing activities of $193,000. We spent out some cash to make some improvements to our property, plant, and equipment. That's okay. We obviously had the operating cash from above to do that. And we would have been able to determine from reviewing our balance sheet and our cash flow statements in prior periods that we did have that capability. We had that room to make those improvements. Again, you just don't want this section to swing wildly. You don't want to have net cash provided by investing activities of $1.5 million 1 year, and then net cash used in investing activities of $2 million the next year. The final section of the cash flow statement is going to be the financing section. This is where you're going to note how you are financing the business with loans or other debt obligations, essentially showing the ins and outs with your creditors. Paying down debt is going to decrease your cash flow, while obtaining new debt is going to increase your cash flow. So negative cash flow here normally indicates a strong business because your company is using operating cash to fund dividends and creditors. Positive cash flow here could also be fine if your business is in a current growth pattern. You need to ensure your repayments of debt are consistent. So again, consistency is key to the financing section, just like it is to the investing section. In our example here, we obtained new debt obligations during the year. So we received $350,000 in proceeds. And then we made debt payments of $145,000. So we had net cash provided by our financing activities of $205,000. Again, that's fine. We were able to make those decisions by reviewing and analyzing our statements over our past history. All three of these sections are going to total up to your total net cash impact for the period. And this is very important. That balance needs to roll from the beginning of the period to the end of the period with this net impact added or subtracted. So in our example, we had net cash increase of $1,263,000. Our cash at the beginning of the period, or at January 1st, was $372,000. And our cash at the end of the period is calculating out to be $1,635,000. That needs to tie to your ending cash balance on your balance sheet. Otherwise, you have an issue or a discrepancy that you need to dig into. And just a helpful tip, if your cash flow is not rolling, you probably want to start in the investing section. I have found over my many years in this accounting world that the investing section is normally where you find the majority of your cash flow issues, just because it really does depend on what the timing of the cash, when you got it in or when you had to pay it out. And that sometimes doesn't line up with how it gets recorded in your general ledger. But overall, maintaining a healthy cash flow is absolutely critical and crucial to your ultimate business success. So you want to keep an eye on this, definitely. And we're going to jump right into financial ratios. So what are financial ratios? Well, they're a business insight tool. It's a useful tool that's going to help companies and investors analyze and compare relationships between all kinds of different pieces of financial information across an individual company's history, or across an industry, or across a business sector. These ratios are going to be able to provide meaningful information on company performance to both management as well as potential outside investors. So preparing and calculating these ratios, relatively easy, some simple multiplication and division. But understanding and interpreting what these ratios say about a company's financial status is going to take a bit more work. So we're going to dive into quite a few of them, at least a half a dozen of the ones that I think are going to give you kind of, again, the most bang for your buck. The ones that are going to be the easiest to implement, but give you kind of the best picture of your company. So overall, ratios are going to serve as a comparative tool of analysis for liquidity, profitability, debt, and asset management, among other categories. These are all extremely useful areas for financial statement analysis. Let's talk a little bit more about what I think to be the main 5 categories of financial ratios are. So first, we have our liquidity ratios. Our liquidity ratios are going to be used to determine a company's ability to pay off current debt obligations without raising external capital. These liquidity ratios go hand in hand with the working capital ratios, because the working capital ratios are a measurement of liquidity, meaning the business's ability to meet its payment obligations as they fall due. Then there's the asset usage ratios. How efficient is a business at using its assets to make money? And these go hand in hand with the efficiency ratios. And these are going to measure a company's ability to use its assets and manage its liabilities effectively in that current period or in the short term. And finally, we have profitability ratios. And this is going to be those series of financial ratios that show how much profit a business is earning. So we're going to do our final poll question here. If I can find my mouse, here we go. We have polling question 3. And this one is saying, which type of ratio do you think, before we talk about them in detail, is going to provide the best analysis for your business? Liquidity, working capital, asset usage, efficiency, profitability, they all work together, or don't know, undecided. And again, we'll give about another 10 or 15 seconds to have everyone a chance to answer the poll. Okay, and we'll go ahead and end the polling and share results. And the top answer is they all work together. You're getting what I'm saying. That's awesome. Yes, all of these ratios are going to work together. I would agree with our next section with profitability. That is going to be the one that most people can relate to, as well as efficiency. These are all key ones that you want to make sure you're having your finger on those pulse points. But if you can get all of them to kind of go hand in hand and work together and dance together, that's going to be the ultimate. Fantastic. Okay, so we're going to dive into some examples. Let's start with liquidity and working capital ratios. So I think one that's going to be one of the easiest ones to do is to determine your current ratio. So your current ratio, which you would figure out by taking your current assets and dividing by your current liabilities, is going to estimate the ability of a company to pay back your short-term obligations. This ratio can also be known as the cash asset ratio, the cash ratio, and the liquidity ratio. If you maintain inventory, you're going to want to also change this to the acid test or quick ratio. You do that by removing inventory from your numerator, so your current assets minus inventory, and leaving your current liabilities alone in your denominator. This is because inventory items typically take longer to go through the sales process, and it could skew your overall current ratio because of this. So a higher current ratio is going to indicate you have a higher capability to pay back your debts. Let's look at these examples. The current ratio here, we have current assets of $1,990,000. We have current liabilities of $543,000. This is giving us a current ratio of 3.66. This is a massively strong current ratio. A good current ratio is between 1.2 and 2, indicating you have nearly double the assets to cover your current liabilities. Our current ratio in this example is almost 4, so we have double the double. That's fantastic. Apparently I was a little too gratuitous in these numbers and made this too strong of a balance sheet. But if you look at our quick ratio right below, when we remove inventory from the current assets number, our quick ratio shows that drops. It's a significant drop from almost 4 to 2.5. So that is why it's important, if you maintain an inventory balance, to look at both your current ratio and your quick ratio, because your inventory items, they're making up nearly 1/3 of your current assets on your balance sheet, which could have a significant impact on if you would be able to pay down your short-term obligations. Any warning signs here? If you have a ratio of less than 1, you don't even have current liquidity to pay off your current liabilities. Not a good sign, not somewhere you want to be. You want to get that turned around as quickly as possible. Staying in the liquidity and working capital ratio vein, let's talk about the debt to equity ratio. You would determine this by taking your total liabilities and dividing by your total equity. And this is going to indicate the proportion of equity and debt used by the company to finance its assets. You typically don't want this, you typically do not want this higher than 2, because lower ratios are going to indicate a stronger company because you're not relying on debt to finance your company. In our example here, we have total liabilities of $718,000. We have total equity of nearly $3.2 million. Our debt to equity ratio is 0.23. Again, super strong debt to equity ratio. Very fabulous. This is showing that this company has really enjoyed some current and past success and have maintained their liabilities and have a good eye on how their company needs to be structured. Please keep in mind, if your company relies too much on liabilities and debt borrowings to fund your business, you are definitely at a greater risk of bankruptcy. Kind of the robbing Peter to pay Paul type statement. If you keep buying or if you keep borrowing money to fund your current operations and your current operations never give you any funding, not a good sign. You need to do something to fix that quickly. So let's move right into efficiency and asset usage ratios. The asset turnover, which you would determine by taking your revenue divided by average total assets, is going to be used as that indicator of the efficiency with which your company is using its assets to generate revenue. And when we talk about average assets, kind of average AR, average inventory, average total, we refer to your beginning account balance plus your ending account balance divided by 2. So keep in mind, this can also be broken down further to examine any type of asset and the revenue turnover they generate. On the next slide, we are going to look at 2 key ones that you should absolutely get folded into your mix with accounts receivable and inventory. Our example here at just the overall asset turnover, we have revenue of 15 million divided by our average total assets of about 4.5. Our total assets turnover is nearly 3.5. Very, very strong. The higher the asset turnover ratio, the more efficient your company is at generating revenue from your assets. Conversely, it's also true. If you have a low asset turnover, you're not efficiently using your assets to generate those sales dollars. And you need to keep in mind, is it time to make some capital improvements? Maybe not. Maybe it's time to sell some old equipment that just isn't cutting it anymore. So as I had mentioned, we are going to dig into accounts receivable and inventory turnovers. So the AR turnover represents the number of times per year you turn your receivables into cash. To calculate this, you would take your net credit sales divided by your average AR. At the same time that you're looking at your AR turnover, you should also be looking at your days sales outstanding, or your DSO. To calculate your DSO, you would take your average AR, divide by your net credit sales, and multiply by 365. This is going to give you the measurement of how many days it takes your company to collect payment after a sale has been made. In our examples, we are turning over our AR 12 times per year, and our DSO is about 30 days, indicating essentially once a month, or it takes us about a month to get sales dollars in the door as cash. This is very, very strong because the industry average is 45. Anything lower than this in our example is you're changing those receivables to cash higher than average, which is a good sign. So these two ratios working together are going to help you determine, are your AR terms too generous? Are you not turning cash quickly? Is it taking you 60, 90, 120 days to turn AR into cash? That could be a problem. But also, if you're turning cash quickly, as in our example, do you maybe have some wiggle room to offer more generous terms to a longstanding customer that in the short term is facing a cash crunch? You'd be able to see that, yep, your company is going to survive if you have to do that. Or maybe you have to offer more generous terms to a customer just to win their business, to get your foot in the door. If you're monitoring this on a regular basis, you'll know if you have that capability to take on additional risk. With the inventory turnover, that is going to measure the rate at which your inventory is being sold and replaced. To determine this, you take your cost of goods sold and divide by your average inventory. Also, at the same time that you're looking at inventory turnover, you want to monitor your days sales in inventory, which you would calculate by taking your average inventory, dividing by cost of goods sold, and multiplying by 365. Your DSI is going to measure how many days it takes your inventory balance to turn into sales. So in our example here, we have inventory turnover of more than 13 times per year, and our DSI is only 27 days. So again, about once a month, we're turning inventory and sales and replacing our inventory. When you calculate and monitor these inventory ratios and analysis, it's going to help you with pricing, manufacturing, and purchasing decisions. Turning inventory more quickly means demand is up for your product. But if you're turning it too fast or too high, it could also mean that your inventory levels may be too low. You might be missing out on some projects or jobs where the customers can't wait for you to get that inventory in, and you don't have it currently in your warehouse. On the flip side, low turnover means product is sitting on shelves and it's in danger of becoming obsolete. Monitoring this is also going to help you determine, are your purchasing and sales departments in sync? Is your purchasing department procuring items that your sales department can actually sell in the market?
Hey, Noelle.
Yes.
I'm going to interrupt you really quickly. We have a good question in the chat. And it reads, for the financial ratio, if we say we have a good ratio result, is it regardless of what industry the business is?
For what we're talking about today, we're talking about across all industries. So I wanted to kind of have the most generic ones that I'm giving you kind of what the good results would be and what the poor results would be. There's definitely ways to fine tune these for your specific industry. And there's guides and all kinds of stuff out there to kind of give you more scope, because maybe in your industry an AR turnover and DSO of 60 days is more realistic because of the industry you operate in. But 45 days is across any industry, any business sector. So yes, I'm trying to keep it more generic so you can apply it to any industry, but you can certainly fine tune for your specific one.
Sounds good.
Okay. Yeah, that was a great question. Great question. All right, our final category of ratios are profitability ratios. And the two key ones, I think, are the return on equity and net profit margin. So return on equity, you would determine by taking your net income divided by your total equity. This is going to give you your measurement of management's ability to generate income from the equity available to it. Essentially, it acts like a return on net assets. And this is going to be presented as a percentage. So in our example, We have net income of $1,350,000 divided by total equity of nearly $3.2 million. We have a 43% ROE. That's fabulous. ROEs in that 15 to 20% range are generally considered good, while anything lower than 10% is usually considered poor. So when you're monitoring this and you see you're hitting that target of 15 to 20%, you can feel good about that. Anything less than 10, you want to take some look at what's going on. Do I need to do some cost cutting measures? How can I have some revenue growth? Do I need to issue new debt? Do I need more investors to help raise capital? Again, these are more generic across all industry percentages to target. For your specific industry, ROEs might be in that 10% range and still be okay. Keep in mind with this particular ratio, you need to be showing both positive net income as well as positive equity. Otherwise, you can't really rely on this ratio. The net profit margin, you would take your net income divided by sales revenue, and this is going to indicate the efficiency of a company at its cost control. So a higher net profit margin is going to show more efficiency of the company at converting its revenue into actual profit. What is falling down from that top sales revenue line to the bottom line net income? In our example, we have net income of $1,350,000 divided by revenue of $15 million. We have net profit margin of 9%. This is a healthy one. This is a very good net profit margin. Your net profit margin is going to be one of the most important indicators of your company's financial health. But remember to keep in mind, this can be heavily influenced by one-off items that occur in one year and don't happen in any other year. And those one-off items can have a significant impact to your bottom line. So it's best to look at this with all the other ratios and analysis during your review to determine a full picture of the health of your company. So just some high-level key takeaways, preparing correct and accurate financial statements and reviewing and analyzing those financial statements in conjunction with those ratios is crucial and key in helping you make important decisions for your company. And it's going to help you with those recommendations based on those trends. And kind of going hand in hand with our question from earlier, there's a ton of other reports and ratios, especially industry-specific items. They're going to help you fine-tune those overall measurements. We just don't have enough time to cover all of those in this seminar. But if you're interested in learning more, you can certainly reach out to us at Donnelly-Boland, and we would help you get together a nice package for your dashboard or business intelligence or BI tool to help you with your business decisions and how to monitor and review and analyze your statements and company trend. Again, this is how your company is talking to you. This is how you know how your company performed. It's just so key to the ultimate success and continuation of your company and business. So that wraps it up. Do we have any questions?
So now that we have this Q&A box, if anyone has any questions, you can ask them directly in there. Also, we have the ability to unmute people. So if you would like to talk, we can do it that way. But there's a ton of information that came in from Noelle today. And, maybe you have some specifics about your industry, your business, things that you're already doing when you get reports from the people who are putting together your bookkeeping. You're like, man, I have no idea what they're even saying. So anything would be totally fine. Do you see that, Noelle, in the chat?
I'm trying to look at the chat. There's like too many pods to look at.
Yeah, so it's the chat. It's in the Q&A. It says, how important is it to review financials on a monthly basis?
Okay. So monthly is a good idea. if you have the time for it. So I'm going to say it's about a 50-50. If you have the time, definitely you want to look at your financials on a monthly basis. But quarterly is going to give you enough times per year to do a detailed review and analysis and get those ratios prepared. But once you have these tools built, refreshing it on a monthly basis shouldn't take too much time. You should have those kind of core schedules created and have a dashboard where you can, maybe it's real time, you're just refreshing. So, if there's tools you can put in place to help you review monthly, that's definitely the way to go. But if you can only do it quarterly due to time constraints or system limitations, quarterly can also be fine. And I kind of went, I didn't get a chance to mention this, but it kind of goes hand in hand with this question. Reviewing your financial statements more regularly and analyzing them is going to key you in on, do you have seasonality or a cyclical nature in your business? And that's going to help you determine when should you be making, major investments in your capital improvements, or when should you be looking at cost-cutting measures. So definitely, if you're reviewing monthly, it's going to help you see those annual trends.
We got a nice comment in the actual chat that said, I would love to attend more webinars for the DBU. I love it.
Yes.
That's what we want to hear. We go to great lengths to make sure that we're trying to engage with people on different topics. And this year it's a little bit different because we're having one every single month. And Anna's going to talk a little bit about that.
Yes, so we have our next one coming up on COVID safety, and it is going to be March 18th, same time. So definitely mark that down if that's something that interests you. But we are, like Matt said, having one every month the rest of this year. So always being on the lookout is good so you don't miss anything. But thank you everybody for coming out today.
Actually, we do have a couple more questions now too.
Oh, sorry about that.
Is there a ratio that measures risk exposure of an entity?
Yes, there are quite a few. That definitely gets more into, you're not necessarily looking so much at your financial predictors, but you're looking at your inherent risk to your specific company and your specific sector. So those get a little more involved and detailed. So I absolutely that would be one I'd want to kind of have an offline discussion with, but yes, it gets, like I said, it gets more involved, but there's definitely ways to put numbers to risk.
And then the next one, what do you think would be the best analysis to help me for budgeting purposes?
So definitely looking at your profitability and seeing your trends in revenue growth, your GP, your net profit margin percentages. That's going to be kind of the first one I would look at. And then I would also use your efficiency ratios, so your asset turnovers, to make sure that you can budget for your cash flow as well as your AR and inventory balances. Those would be the top two I would look at.